Welcome to this video. In this video you will learn how to develop a winning trading strategy. So without further ado, let's get going. First of all, why even bother developing your own strategy? Why not just copy someone else's? Well, everyone is different, and the best trading strategy for me might be very different from the best trading strategy for you. Everyone has a different personality, different preferences, different strengths and different weaknesses. So why not develop a trading strategy that is perfect for you and your situation and your strengths? Wouldn't that just be great? Well, in this video you will learn how to do exactly that. This video is especially useful for those of you that currently don't even have a concrete own trading strategy. Without a clear trading strategy with a real edge that tells you exactly what to do and when to do it, you won't come very far in the world of trading. So listen up. So first, let me present you with the right approach to developing your own trading strategy. It is very important that you approach developing a trading strategy in a professional manner. Otherwise, you won't get any professional results. If you're thinking right now you could just go to some charting platform, watch a few stocks here and there, and then develop your own trading strategy from that, then you're wrong. Let me tell you the right approach. I recommend using the scientific method when developing a trading strategy. You should think of yourself as a scientist that is trying to find a cure for some serious disease. You can't just randomly mix random different chemicals and thereby stumble upon the cure. Instead, you have to have a clear plan and you should know what you're doing. So let me introduce you to the scientific method when developing your own trading strategy. First of all, you have to observe something. So you start with an observation. A trading example here would be, let's say, certain stocks that have had 3 or more major green days behave in a certain way. Namely that they have a big red day after those big 3 green days. And this is just a random example, I'm not saying that this is real. The next step would be to ask a question based on your observation. So for instance, is the big red day that occurs after multiple major green days predictable, and if so, how can you take advantage of it? So after asking your question, you form a hypothesis. You form a proposition that tries to explain the observed behavior. For instance, the first green to red move after 3 or more major green days is a signal for a reversal. After doing that, you collect data, experiment around and test your hypothesis. The trading example here would be to track certain stocks that behave in a certain way. Alternatively, you could also backtest. So after collecting data on your hypothesis, it's time to analyze that data. So you order the tracked data and analyze it. For instance, you try to identify patterns and anomalies and other similar things. After doing all that, you draw a conclusion. And ideally, this conclusion answers your initial question and evaluates your hypothesis. For example, if we go back to the example with the 3 green days followed by a major red day, the conclusion could be the big red day after multiple major red days is predictable and a fast red to green move could be used as a reliable entry signal for a short position. Depending on your conclusion, you might want to start this entire process over again. The reason why I really recommend using the scientific method is because it allows you to identify a true edge in the market. It allows you to find setups that are truly predictable and that you can make money off consistently. Every trading strategy needs a real edge. If you don't have an edge, you won't be profitable. With the real and true edge, I mean something predictable that can be taken advantage of reliably and on a consistent basis. If it's not reliable or doesn't occur more than once, you can't really develop a trading strategy about it. Let's say one thing happens once and it's predictable, then you can't trade off of this one thing over and over again because it only happened once. That's why it has to happen multiple times, be reliable, and occur on a consistent basis. If you're unsure what I mean with the real edge, just think about casinos. Casinos have real statistical edges, and that's why they make money. No casino would be open if they wouldn't have an edge. So the goal is to develop a trading strategy that allows you to trade like a casino. With that out of the way, let me introduce you to the most important components of a winning trading strategy. I created this diagram that symbolizes a trading strategy. So we start with the foundation. The foundation is the most important part. If the foundation is unstable or doesn't even exist, the entire thing will collapse. So really focus on getting a good foundation. And by foundation I of course mean a true edge. An important characteristic about a real statistical edge is that it works in the long run. It doesn't have to work on every trade. Regardless of how good your strategy is, there will be some losing trades, but just focus that in the long run you will come out profitably. Next up we have the first pillar, which is the setup. And this is what helps you identify your edge. The more concrete and objective this is, the better. The setup could be something like a chart pattern, but it could also be something completely different. If we go back to the example that I talked about earlier, the setup would be 3 major green days followed by a big red day or something like that. And like I just said, make this setup concrete. For instance, say that only stocks in a certain price range should be traded, or stocks with a certain market cap that showed certain behavior or something like that. The next pillar is your personality and personal preferences. Like I said in the introduction of this video, everyone is different and everyone has personal preferences. You have your strengths and I have my strength, and we both have different weaknesses, or at least that's likely. It is essential that you develop a trading strategy that is designed to fit your personal preferences and your strengths. And just to give you an example, for instance, if you have a $10,000 trading account, your strategy must be adjusted to be suitable for such an account size. You could not trade a strategy that requires millions of dollars. A different preference could be if you have a full-time job and can't monitor the markets very frequently. Then you probably shouldn't develop a trading strategy that requires you to do so. If you're bad at making decisions under time pressure, you should also account for that in your trading strategy. I hope these examples give you an idea of how personal preferences and your personality should influence the development of your trading strategy. The third and final pillar is adaptation and refinement. Developing a trading strategy is not a short process that you do for a few days or weeks and then you're done. You're never really done. Markets always change, so you always have to adapt and refine your trading strategy to the changing conditions. A trading strategy will never be perfect. You can always improve upon certain aspects, so try to do that. Last but not least is the roof, which is the execution of your trading strategy. This is where everything comes together. Without the roof, your strategy wouldn't be complete. This is where everything else is translated into real results. Everything else is the theory, whereas the execution is the practice. Executing your trades can be done in a variety of different ways. For instance, you could theoretically create a trading algorithm that trades your strategy, but you could also, of course, trade your strategy manually. I hope this diagram gives you a good idea of what you should include in your trading strategy. Now I want to present you with another approach that's also very good in developing a trading strategy. This approach works just like a funnel. In the beginning, you have something very vague and unspecific, and then you filter out certain things, and in the end you have something very specific, which would be your trading strategy. And here is an example of such a thing. The first level of your funnel could be asset class. For instance, you choose which assets you want to trade in your strategy. This could be stocks, options, futures, commodities, forex, or whatever. The next level could be the time frame. Do you want to focus on short-term, day trading, or swing trading, or long-term investing? Then there could be other specifications for your chosen asset class. For example, if you chose stocks, you could further filter out those with a market cap under a certain amount, or price over a certain amount, or just filter out stocks that trade less than a certain amount of volume. Further specifications could also be which sector the stocks are in, the float, or certain technical indicators, and more. Even more examples would be something like price action and news events. I hope this gives you an idea of how you could go about in developing your trading strategy with this funnel approach. Now, let me end this video by drawing a conclusion. So first of all, what exactly is the goal of developing a trading strategy? The goal of developing a strategy is that in the end you have a trading strategy that perfectly matches your personality and takes advantage of your strengths, and that has a true edge. A good way to test if you have a real trading strategy is to put every single aspect and detail of your current strategy to words. If you can write down everything from the entry to adjustments to the exit and explanations of everything and why you're doing everything, then you have a strategy. And if you can do this, I really recommend doing this. Because if you do this, you can always put that piece of paper or note or wherever you wrote it on next to yourself while trading. And if you're ever unsure about what to do, you could just look at that piece of paper and your question would be answered. So if you reach this point, you go from being the gambler to becoming the casino. A few last tips before I end this video that are important when developing a trading strategy is that you are consistent, you have a consistent approach, you don't change your approach every few trades, because if you do that, then you don't have a real strategy. The next tip is use data when developing a strategy. If you don't use data, then you can't really say if you have a real edge or not. Furthermore, never stop refining, markets change, and so should your strategy. There's no such thing as a perfect strategy, and also have the right mindset. Don't expect to create a trading strategy that will make you millions overnight. That won't happen. Have realistic expectations. In addition to that, be professional, otherwise your results won't be. And last but not least, work like a scientist. Remember, you're a scientist that's trying to find the formula to the market. This will take a lot of trial and error, but it's very important to not give up. If you achieve your goals, it will be well worth the time and effort, believe me. Thanks so much for watching. I really hope you enjoyed this video and learned a lot. If you have questions about anything or just comments, please let me know in the comment section below. Otherwise, it would be great if you could subscribe if you are interested in content like this. See you in the next video.